Hi there, here's a quick A2 macro revision video looking at the euro, but in particular the question we're going to focus on is whether some of the smaller EU nations, including some of the new member states, should they join the single currency. There are currently 28 member nations of the EU, 9 of whom are yet to join the single currency area, and they include countries such as Poland, the Czech Republic, Hungary, Bulgaria, Romania, and the newest EU country, Croatia, which joined the EU in 2013. Of course, the UK is also outside the single currency area. We have chosen to negotiate an opt-out from that arrangement. Every country can choose their exchange rate system. So the euro itself is a floating exchange rate, but the 19 Eurozone nations within the system, of course, have agreed to share a common currency. The UK is outside the euro. It has a floating exchange rate. Bulgaria is also outside. It has a currency board system, a fixed exchange rate with the euro. And Denmark also has a fixed peg against the euro. So effectively, Denmark is fixed as a currency to the euro, although it lies outside the system. So decisions have to be made by countries at some point in time about whether or not, if they're inside the EU, they choose to join or stay out of the euro. Lithuania came into the EU in 2004, same time as Poland, and Lithuania joined the single currency area in 2015. Poland has been inside the EU for 12 years now, but has chosen to stay outside the single currency area. It's kept their currency, the zloty, which is a free floating exchange rate. Denmark, of course, is outside the krona. The currency is fixed, the euro. Greece is inside the euro, and we know that country has had many significant economic, social and political problems in recent times. I'm sure you've studied them. Now, we're going to think about whether or not countries inside the EU should join the euro. Let's have a little bit look at the macroeconomic backdrop. So if we take countries like Poland, which is outside the single currency area, and the Baltic states, Lithuania, Estonia and Latvia, have all chosen now to be inside the single currency. They're in. Greece here in turquoise blue is inside the single currency too. This chart first of all shows GDP per capita, and you can see the impact of the recession and the depression in Greece on their per capita incomes. Indeed, they're now poorer on a GDP per capita basis, PPP adjusted, than several of the new EU nations that came in 24. The Eurozone as a whole has struggled to grow, but the European Union has continued to increase its per capita incomes since the last recession. This chart shows the rate of growth for these countries, and you can see the depth of the recession in 2008-2009. In particular, a lot of the Baltic states had a boom in the first 4 years since they became an EU member state, but this boom was completely unsustainable. They went from growth of 8 to 10% down to minus 10, minus 12% a couple of years later, because the credit boom was completely unsustainable, and that led to high inflation and eventually some years of deep recession. But as a result of that recession, there was a lot of internal devaluation, a lot of adjustment, and they're now growing relatively quickly. Even Greece is returning to growth this year. But the European Union as a whole is struggling to grow at more than 2%. Inflation is quite a big issue. Again, you can see the unsustainable boom in the Baltic states in the mid to late 2000s, the noughties. Then inflation came down with a recession. Of course, the big story at the moment is the fact that many countries inside the Eurozone in particular, I think 7 Eurozone countries, are now technically in deflation, where the rate of inflation is negative. And the other issue I think to think about is unemployment. The rate of unemployment here measured as a percentage of the labour force. Again, you can see the sharp rise in unemployment in countries such as Lithuania and Latvia and Estonia. Since then, their unemployment rates have come down quite sharply, although they remain above 10% in some cases. Of course, Greece has suffered horrendously, their unemployment rate rising above 25%. Signs that it's now starting to peak and come down. But they're still at horrifically high levels, in particular youth unemployment, more than 50%. Interesting here that Poland, which is outside the single currency, their unemployment rate only went up modestly during the financial crisis. Indeed, Poland avoided a recession. I'll talk about that in a second. And their unemployment rate is now falling again to about 6 or 7%, which is below the EU average. Current account balances, this is a measure of external balance. Again, these Baltic states were running huge deficits 10 years ago, and the credit boom was sucking in imports. But actually, in terms of external balance, lots of countries have now improved their current account position on balance of payments. Poland, though, is a country with quite a sizable current account deficit. And you can make a case for saying that they probably need to keep a flexible exchange rate in order to remain competitive. So here we go. Let's look at some arguments for smaller countries joining the euro. As I say, there are 19 countries inside the euro at the moment. Would it be good, would it be right for countries such as Poland, Croatia and the Czech Republic to join? Well, here are some of the arguments. First of all, if you're inside the single currency area, then you're helping to eliminate some of the currency conversion or transaction costs that trade in goods and services involves. If you think about it, every time you swap currencies, you're going to pay commission. And effectively, if you're using more than one currency to trade, that trade involves a tax. So if you join the single currency, you eliminate some of the transactions costs. And point two is that single currency membership should, in theory, be a fillip to trade creation effects, and also inward investment. So for some of these smaller countries, in the case of Latvia and Lithuania and Estonia, for example, the hope is that being part of the euro will stimulate more inward investment, more inward FDI, which can create jobs and lift per capita incomes. Partly because the euro as a currency is probably more stable than the currency of a very small country. There's an argument too for saying that being part of the single currency enhances your economic stability because you're in with 18, 19, perhaps 20 other countries, and you have the support, financial support of the European Central Bank as a kind of lender of last resort if you run into financial difficulties. Point four talks about dynamic convergence. The idea here is that once you're inside a single currency area, you can no longer rely on a depreciation of the exchange rate to make you more competitive. So businesses, for example, in Estonia and Latvia, will need to be more competitive over time because consumers can very easily compare prices of goods and services in euros across different countries, and they'll tend to go to the cheapest buyer. Point five is a recognition that for very small countries, and the likes of Latvia and Greece and Malta and Cyprus and Croatia are in global terms extremely small countries. It's very hard for small countries to manage their own free-floating exchange rate, particularly in a world where capital moves across national boundaries so quickly, things like hot money. Hopefully, in the long term, if you join the single currency, businesses from those countries will have easier access to borrowing from bond and money markets. So, for example, Croatian companies can maybe issue bonds in euros at a lower rate of interest than they might otherwise have had to do. Or it might be easier for a Polish company, if it joins the euro, to go to other European stock markets to raise money. Partly because the currency instability or the risk factor may have fallen. And lastly, we can't ignore the politics that if you think about the Baltic states in particular and the geopolitics of Russian influence in that part of the world, if one thinks about the fact that the Eastern Bloc only really collapsed in the late 1980s into the 1990s, being part of the Euro Union and the Euro itself, I think is important for geopolitical reasons. It helps align those countries more closely, permanently if you like, with the West against as a bulwark against the geopolitical ambitions of Russia under Putin. So you can't ignore the politics, but if you get a question on the euro, always try and focus on the economics first of all. However, there are of course counter arguments as part of your evaluation. You might want to challenge and question whether these countries should be part of the single currency. Point one is that in countries inside the European Union but outside the euro, such as Poland, such as the UK, well, they retain greater autonomy over their macroeconomic policy. Their central banks have freedom to set their own interest rates for domestic objectives, for example, grow the economy or keep inflation down. Countries such as Poland maintain a floating exchange rate, and the zloty fell in 2008-2009 during the recession, and that actually helped stabilise the Polish economy at a time when the European economy was heading into recession. Indeed, Poland basically avoided a recession. So you can make a case for saying that a floating exchange rate helps to provide a shock absorber in the face of unexpected external shocks. And likewise, if you join the single currency, then you almost certainly have to sign up to some fiscal rules about how much governments can borrow and how much debt they can run, And again, some countries prefer to have their own more freedom over their budgetary or fiscal policies. Point 2 is the argument, fundamental points. Many people would say that the Eurozone as designed is flawed. It's not an optimal currency area, and the risk factor of joining is greater compared to the benefits. Think about the potential exposure to contributing to the future bailouts of European Union members. And also, crucially, the fact that if you join the single currency, you have to accept the policy rate set by the European Central Bank. And it's very hard for the ECB to set one interest rate that fits all the economic requirements of 19 or more member nations. So that's an important economic point, that the interest rate that's set by the ECB is probably not right for any of the Eurozone countries. Third point is that if you shift to the Eurozone and interest rates go down from what you're used to, the risk is that you end up with a big housing bubble and the build-up of debt, which can be a big threat to stability. In other words, you can't go into the euro unless you've sorted out your macroeconomy. And also the point is that once you're inside the single currency, you can't rely on a depreciation of the currency to become more competitive with your fellow Eurozone members. And therefore there's quite strong pressure on businesses to raise productivity, to cut their unit costs, and to downsize and rationalise. So some people fear that joining the single currency can lead to cuts in real wages, affects people's living standards, and could also lead to job cuts as part of a process of internal devaluation of a country's costs. And so the fear is that joining the single currency can actually add to unemployment, both cyclical and structural. And then critics of the euro point to countries such as the UK and Poland, who seem, on the face of it, to have done relatively well in recent times outside of the euro. Poland's avoided recession, of course the UK didn't, and Poland's done relatively well in terms of income convergence. Its per capita income is now converging more towards the European average, and indeed pretty much soon may overtake that of Greece. And Greece overhangs so much of the debate. I mean, it's clearly the case in evaluation that countries joining the single currency need to avoid what's happened to Greece. They need to be competitive and more stable and more sustainable than the Greek economy inside the single currency. So there are some of the arguments for staying outside the euro. The arguments for the UK, of course, are more to do with should we stay inside the European Union. The Eurozone debate is pretty much over for the UK. Hence, the debate is switching towards those smaller European countries. Good luck with your exams, everybody. Hope this has been useful for you, and take care. See you again sometime soon.